Do you think you make too much money to qualify for a USDA loan? You might be wrong. Most people check the income limits and stop there. But what they don't realize is that the USDA allows deductions that can bring your income below the limit. In this video, I'll break down everything you need to know about USDA income eligibility, including what counts, what doesn't, and the deductions that could help you qualify. Let's first define what household income is. That is the gross income of all individuals living in the home, both applicants and non-applicants. Gross income means the money you get paid before anything gets taken out of your paycheck, like taxes, insurance, 401k, things like that. Then there's the adjusted income, which is your gross income minus deductions. I'll talk about what can be deducted later. Then there's the repayment income, which is only the qualifying income from applicants on the loan. Sometimes this can get a little tricky because you can qualify, you'll meet the eligibility requirements for income, but then your repayment ability could affect how much home you can buy. Repayment income is different from household income because it only includes the income of the actual loan applicants, not every adult in the home. This is the income that lenders use to determine how much home you can afford and whether you qualify for the loan. Lenders analyze repayment income to ensure it's stable, dependable, and expected to continue for at least 3 years into the mortgage. This is why income sources like temporary jobs, short-term contracts, and one-time payments are typically not included in repayment income. Even if your household income meets the USDA eligibility requirements, your repayment income must be strong enough to support the mortgage payment and other debts. For self-employed applicants, repayment income is calculated using a 2-year average of net income after business expenses. If a self-employed applicant only has 1 year of tax returns, some lenders may not count the income, depending on the situation. There are income limits with the USDA loan, like you've heard me allude to. For the guaranteed loan, that's no more than 115% of the area's median income. For the direct loan, it's between 50 and 80% of the area median income for low income, and less than 50% of the area median income for very low income. I have a link in the description for different resources, one of them being the income limit, so you can check that out. You can also go to workwithdang.com for a USDA quick start guide and more free resources. And if you need help finding a real estate agent, that information is on my website. Now let's get into exactly what gross income is. Here are the things that count. Your employment wages, including your W-2 and self-employed income. Again, this is gross income, meaning this is before taxes are taken out. Bonuses and commissions are also counted. Non-employment income, things like Social Security benefits, child support, alimony, disability payments, and investment income can all count as gross income. For Social Security benefits and other payments that aren't taxed, they can get grossed up by as much as 25%. This means they increase the income to an equivalent pre-tax amount since USDA uses gross income for qualification. For example, if you receive $1,000 per month in tax-free Social Security benefits, your lender might count it as $1,250 in gross income for USDA eligibility. It's important to note that with the USDA Guaranteed Loan, each lender will have their own set of overlays, so not every lender will gross it up to 25%. Some may be 10% or 15%. That's why it's good to talk with multiple lenders to see which one will work best with your situation. It probably makes sense to mention this now. This video is meant for edutainment purposes. I like to give people as much information as possible about these loans and the requirements, but requirements change from time to time, and ultimately each person's situation is different. On top of that, each underwriter can interpret your financial situation differently. All that to say, use this video as a starting point to get a general understanding of how things work, but ask your lender questions and lean on their expertise. Now let's talk about the income from non-applicants. That means maybe you have a parent living in the household or an adult child or someone like that. Even if they're not going to be on the loan, their income still counts toward USDA income eligibility. Let's go into this a little bit more. Only people over 18 have their income counted, not minors. A full-time student who's 18 or over and taking at least 12 credit hours of school will only have the first $480 of their income counted. Let's say you're currently living with a partner, roommate, or something like that, and they're not going to move in with you to your new house. Lenders may ask for documentation, such as a lease or written statement, to confirm the roommates or non-applicant partners will not be part of the new household. A temporary live-in aid, foster child, or foster adult wouldn't count. Now, as promised, let's talk about deductions. There are child and dependent deductions. There's a $480 deduction per dependent under 18 years old. There's also a $480 deduction for full-time students over 18 18 who are non-applicants. So if you have a full-time student that's over 18 and they work, they get adjusted to $0 essentially, since only the first $480 of their income is counted and they get a $480 deduction. If the full-time student doesn't work, then you get the full $480 deduction. If you're applying yourself and you're a full-time student, this $480 deduction doesn't count for you and your full income is counted. There's a $400 deduction that applies to households that include at least one person who's 62 years or older or a disabled individual. The deduction can only be applied once per household. So if you have two senior parents living with you, you only get the one $400 deduction. You wouldn't get $800. Childcare expenses can be deducted if it allows the applicant to go to work or school. For this, you might need receipts, invoices, and proof of work schedule. The childcare expenses only count for children 12 and under. Medical expenses can also be deducted. Now, this only applies to households with an elderly or disabled member, and medical expenses must be unreimbursed, so they can't be covered by insurance or other sources. Let's go over an example. Let's say a household earns $110,000 per year in gross income, but they have two dependent children under 18 and pay $8,000 annually in childcare expenses. They also have two senior parents who will live with them. Here's how their adjusted income is calculated. So first, you take your gross income of $110,000 and you subtract that with the child deduction, which you do that 2 times for $480, so that's subtracting $960. Then you subtract $8,000 for the childcare expense deduction. The senior deduction would be $400, so you wouldn't do it twice. Again, you can only do this one once, even if you have 2 or more seniors living with you. So you subtract that $400, and then your adjusted income is $100,640. This could bring the household under the income limit and allow them to qualify for the USDA loan. This is why deductions can be a huge advantage if you're slightly over the income limit. Now there's the repayment income. This focuses solely on the borrower and co-borrower, the applicants applying for the loan. Only their income is counted for repayment purposes. Non-applicant household member income, such as parents, an adult child, or whoever, is excluded, unless they're applying for the loan. For self-employed applicants, lenders are going to use your tax returns and take a 2-year average to calculate self-employment income. Something that comes up sometimes is when someone says, well, I worked a W-2 job for 5 years at the same employer. I'm in the same business now, but I started self-employment a year ago. When a loan officer is looking at your repayment income, credit score, and financial situation, they're trying to figure out, is this person going to be able to pay back this money? Are they reliable? So in this scenario of a self-employed person who has a good work history, an underwriter might say, hey, this is fine, they're in the same industry. Another underwriter might say, this is a newer business and we can't count this as reliable and stable income. Regardless, it doesn't hurt to apply and just see what happens. There's some special considerations when it comes to income. Social Security and disability income count, as I mentioned before. They're counted as gross income, but they're also fully included in repayment income. There's no expiration of income within 3 years allowed for repayment purposes. Let's say you have some sort of settlement money or something like that, and it's going to expire in 2 years. That wouldn't count for repayment purposes because it has to continue for at least 3 years. And just to be clear, these forms of payment would have to be to the applicants themselves. Again, it's not for people who's just going to be living in the home. Like, let's say your grandmother's going to be living in the home and she has Social Security. That wouldn't count if she's not going to be on the loan. Typically, when an underwriter is looking at your income, they're trying to figure out, okay, can they do this for the next 3 years? Can they make these payments? They want you to be able to afford payments for the life of the loan, but what they're looking at is 3 years into the future to determine if you're going to be reliable in making those payments. For seasonal and variable income, it's going to vary if that income is included in repayment income. Stability is key with seasonal income. So let's say you have a seasonal job that you do every year. Maybe you work retail around Christmas for extra money. If you work the same place and you do it every year, then that income may count toward your repayment income. Income from overtime, bonuses, and commissions can be included in repayment income, but USDA requires it to be consistently earned over the last 2 years and likely to continue. If bonus or commission income fluctuates, lenders will average the last 2 years' earnings or use choose the most recent lower amount. Let's talk about some common reasons why income is excluded from repayment income. Temporary one-time or lump sum payments like lottery winnings or a settlement, short-term disability or unemployment benefits unless a stable history exists, income from a part-time job that hasn't been held for 12 or more months, student financial aid, grants, or scholarships, even if used for living expenses. Check out this video about USDA loans. Please like, comment, and subscribe if you've gotten any value from this video. It helps me out a lot.